This is Sarah Cage Richter, and I'm joined by my co-host, Adam Olsen. And back for more, we have crowd favorite Nicole Harger, Embark's National Quality Director. Now, y'all keep me up to date on what's relevant in the accounting world, so I thought maybe you could keep me up to date on what's relevant in the entertainment world. Do you have a movie, a TV show, or a podcast you would recommend?
I'll let you go first.
I just recently finished Inventing Anna.
Oh, I've heard about that one, yeah.
Well, I know there's a new season of the Great British Baking Show about to start,
Ooh.
so and I'm a fan of that, so I'll definitely be keeping up with that one again.
All right. I had to warm you up a little bit before we dove into the meat of stuff. So today's topic is about the new guidance around debt and equity financing and ASU 2020-06. Maybe you turn that into a bingo game, how many times we say that in this episode. This is incredibly timely since public companies will be adopting this for Q1 2022. So let's jump into it. But before we get too far into the who, what, and when, Adam, can you talk quickly about why this is important for reporting entities?
Sure, and I think you helped kind of tease that out a little bit. So obviously for our public company listeners, those people that have to file Q1 financials coming up here, 2020-06 will be effective for those entities that have instruments that are in the scope of some of the changes that were made that they'll need to look at in their first quarter. And so given the timing of this podcast, which is right after kind of the close of Q1 for most calendar year-end companies, it definitely should be top of mind for those that are helping prepare those, Q1 statements. For those that are on the non-public company list, you have a little bit more time, like with any other new standard, so it won't be effective there until in 2024. But it may be something to listen to and think about potential early adoption, because the overall kind of theme or consensus we'll be talking about throughout this conversation today is really about helping make things easier, simpler, less complex. So I think that rings a lot of bells in people's heads, like, hey, if I can make this easier for me, maybe it's something worthwhile to bring forward earlier than later.
Yeah, I think that's really helpful to set the stage. I know in past podcasts we've hit on that topic of simplifying existing complexities in U.S. GAAP. So what's the story on how this technical project came to light?
Yeah, so I guess the genesis of this is, so the actual technical project went on the FASB's agenda back in 2017, but it arrived there really from kind of some soul searching, I guess, from a subcommittee as part of the FASB. So it's the Financial Accounting Standards Advisory Council, and they really kind of reach out to stakeholders periodically, just kind of get feedback on how standards are working, not working, where people are having issues. And so part of that kind of periodic survey they did kind of brought to light just general complexity with distinguishing liabilities from equity and debt and equity financing in general. And so that was reported back to the FASB. They went again and did an official consultation for their technical agenda and put those topics out there as items. And to no one's surprise, it came back from respondents during the comment letter period that, yeah, we definitely would like to see something added to your agenda to look at this guidance, because it has been, pretty tricky to navigate.
So is it fair to say the FASB issued this ASU really in response to trying to help preparers with this existing complexity?
Yeah, that's, like I said, it's going to be the theme today. It's really about, a lot of people got lost in the guidance. It is very convoluted. We'll talk a bit about, when we talk about some of the changes, some of the current guidance, and you'll kind of see why it could be such a web of accounting literature to get through. But really the complexity also led to just a lot of errors in application. So, which could obviously lead to restatements, revisions in financial statements, just as people are trying to understand and navigate the guidance and apply it to their different contracts and agreements. And then, one other real big reason too that came through kind of the feedback from stakeholders was that users of the financial statements didn't necessarily even find the accounting conclusions and presentation under the current guidance that useful. They weren't making any more meaningful decisions based on that guidance. And so it was almost like, are we doing all this extra work for whose benefit? So, kind of taking that into consideration, it really helped kind of catapult the FASB into start looking at some revisions to the guidance.
Okay, I think that's really helpful context as we get into the meat of this. So, Nicole, let's move into the ASU itself. I know the ASU changed several areas of US GAAP. Can you maybe touch on what areas are going to impact our listeners? I mean, if I'm listening to this, I might just tune it out if I don't have any convertible instruments. Would they still be impacted even if they don't have convertible instruments?
Yeah, so first, the ASU really addressed three kind of key topics. The first is accounting for convertible instruments, so think convertible preferred stock, convertible debt. The second is accounting for certain contracts in an entity's own equity, specifically applying the guidance in ASC 815-40. And then third, just certain aspects of EPS guidance. To your point, while an entity may not have a convertible instrument today, they may enter one down the line. And then also, non-convertible financial instruments subject to ASC 815-40 are impacted by the changes in the equity guidance. Lastly, public companies who report EPS measures will need to consider those changes, and all entities will need to look at the additional disclosure requirements as a result of the new standard.
So maybe just to help give our listeners a better understanding, we can take the convertible instrument changes and compare the current guidance to the new guidance that's coming up with the new ASU.
Yep, so the existing guidance requires issuers of convertible instruments to apply one of 5 different models depending on the terms of the instrument. These 5 models were the embedded derivative model, the cash conversion feature model, the beneficial conversion feature or BCF model, the substantial premium model, and then no separation or single instrument model. The first four models, if in scope, required separate accounting for convertible features, and then it also had its own set of measurement guidance. Each of those models had to be evaluated in succession if the previous model was determined not to be in scope. So in other words, it was a very challenging and lengthy exercise. Given that, it was often, the guidance was often kind of determined to be difficult as users were going through it, and users often view convertible instruments as a single instrument anyway in evaluating financial reporting. So the ASU ultimately eliminated 2 of the 5 models, the cash conversion features and the BCF model.
Well, that sounds like a win to me. Fewer things to sift through. So what happens for reporting entities who previously had one of these instruments accounted for under one of those old models, the 2 that we eliminated?
Yep, so a reporting entity under those previous models would have had an equity component that was separately recognized. So in adoption of the new standard, the company would have to unwind that accounting. In most cases, the convertible instrument will now just be accounted for as a single instrument or under the no separation model. I will caveat one thing to consider here. In most cases, a reporting entity that had convertible debt probably did not assess whether the instrument was issued at a substantial premium or not. And so if that's the case, that model needs to be assessed first to make sure that there isn't a substantial premium in the instrument, because that model still exists after the new ASU.
So Adam, I noticed Nicole just specifically said convertible debt. Does convertible preferred stock need to be assessed as well under the substantial premium model?
Yeah, that's a good catch. And no, she's not wrong. So the substantial premium model does only apply to convertible debt instruments, or if you happen to have a convertible preferred stock that was classified as a liability. So if you've got equity classified preferred stock, it would not apply the substantial premium model. So if your equity classified preferred stock previously was subject to cash conversion or beneficial conversion, with those going away, you basically just end up with a single instrument, so just basically a preferred stock.
So I'm curious, why did they not just go ahead and eliminate the substantial premium model as well?
Yeah, that's another good question. So Originally, it was actually part of the discussion, so they were actually looking to eliminate all three of those models and really just leave us with like the embedded derivative model or just a single instrument model. And so that was on the table. It was during the comment letter process, there was actually feedback that in certain circumstances you could have a convertible debt instrument that was issued at a substantial premium that could ultimately give rise to net interest income versus interest expense. And so that accounting answer would just seem kind of wonky when you think about the context of the premium in the convertible instrument itself. So to help avoid some of that accounting, they ultimately decided we'll leave the substantial premium model as one of the relevant models you still have to apply for convertible debt. So that's still on the table. I will say that of those three old models, the substantial premium model is actually pretty easy to apply. There's really very limited judgment that goes into it. You essentially have your debt instrument that's issued at a par, and then any amount over that par amount is essentially just recorded as that premium into APIC. There's really no other like valuations or big judgments you have to make there. So the guidance for applying that model, even though it is retained, is much easier than the two models that were eliminated.
So I think that gives us a pretty good picture of changes to convertible instruments. So let's move to the second area where the ASU made some changes, which was contracts in an entity's own equity. I know the guidance for the own equity scope exception in ASCA 15-40 can be quite cumbersome, just like trying to say that out loud. So where did the FASB focus on making its changes?
Yeah, so the final ASU changes are really focused on one particular area of the own equity guidance. Specifically, the ASU eliminated and clarified some of the requirements for a contract or embedded derivative that is potentially settled in an entity's own shares and meeting the indexation guidance in order to be classified as equity.
Okay, so let's look at those requirements. For those who aren't familiar or haven't committed to memory the original requirements, like Adam probably has, can you walk through what reporting entities needed to do pre-ASU 2020-06?
Yep. So under current guidance, companies are required to use and reference ASC 815-40, like you said, in order to determine the appropriate classification for freestanding equity-linked instruments, as well as whether embedded equity-linked features that are not clearly and closely related must be bifurcated from their host and accounted for as liabilities. So in order for freestanding equity-linked instruments and equity-linked embedded features to be classified as equity, there were 7 criteria that had to be met. The first is settlement is permitted in unregistered shares. An entity must have sufficient authorized and unissued shares. The contract must contain an explicit share limit. There's no required cash payment if an entity fails to timely file. There's no cash settled top off or make whole provisions. There's no counterparty that ranks higher than shareholder rights. And then lastly, no collateral is required.
Yeah, and I would just add like that list of 7 requirements is really designed to like identify situations where an issuer might be required to cash settle a contract. So whether it's a freestanding equity-linked instrument like a warrant, or if you've got an embedded feature like a conversion feature, like in a debt host, are there any circumstances where exercising those rights or contracts could require the company to have to pay cash? So it's looking for circumstances where, they could fail to meet the share settlement requirement.
Well, I got tired just hearing the list, so I'm pretty glad to hear they're simplifying things and some of those are going away. So which ones are being eliminated?
Yep, so 3 of those 7 conditions were eliminated. The first is whether settlement is permitted in registered shares. One thing to keep in mind on this one is that if the contract explicitly states that the entity must settle in cash if registered shares are unavailable, then this condition still applies. And then the next 2 conditions that were eliminated were the no counterparty ranks higher than shareholder rights, and then no collateral is required. There was also one condition that was clarified around penalty payments. So in regards to that, the ASU noted that penalty payments made upon an entity's failure to make timely SEC filings would not preclude equity classification. Overall, these conditions were viewed as some of the more complex to evaluate, and so we're happy to see them go.
So who's likely to benefit from these changes, and what is the expected accounting outcome?
Yeah, so like I said, reporting entities, or if they've got a subsidiary that consolidates into them, where they're the issuer of those types of instruments. So warrants, convertible instruments, other derivatives they may have on their own stock. Those are the entities that are going to be impacted because they would have had to go through this guidance. But like Nicole said, the guidance really is helping eliminate how many of the more kind of gray areas that you have, because there is some like judgment in there. A lot of times those conditions that were removed required a lot of like legal interpretation or a real thorough analysis of the contracts, and it could get pretty hairy trying to figure out yes or no on some of those. So as a result of taking those out, we're likely to see, just from a financial accounting and reporting perspective, we're going to have less freestanding instruments that are going to be recognized at fair value, or embedded derivatives being separated and recorded at fair value, and having those fair value changes run through earnings. So less activity there. And then also from just like an investor or counterparty perspective, if you think about it, they kind of welcome these changes as well, because they're able to still include those conditions in the contract themselves, but those conditions will no longer impact the accounting outcome. So they can still require collateral and protect them as an investor, but they don't have to worry about that impacting what the accounting might look like, for example.
So we've talked a lot about the theory, but what should companies start doing if they have some of these types of contracts or embedded features?
Yeah, so hopefully if you are a public entity, you've been thinking about this standard, it's been issued now for almost a little less than 2 years, I guess. But first thing is obviously looking at all your contracts, or contracts that have embedded features where you've previously classified any of those either as an asset or liability, or you bifurcated the embedded feature based on some of these provisions in the past. One thing you need to keep in mind is that identifying those alone may not be the only step. There may have to also be more robust analysis that's performed. For example, if you evaluated a feature in the past and you determined it didn't meet the equity guidance because it met one of those conditions that have now been removed, but you stopped there because you knew it was going to fail, you may not have looked at the remaining conditions. So if the condition that originally failed is now off the table, you might still have to go back and look at the remaining conditions if you didn't previously evaluate those, just to make sure that there's nothing else in there that would trigger you to still have that or still require that contract to fail the equity guidance or the embedded feature to be a derivative.
So what happens to these pre-existing instruments and features at adoption? Where could reporting entities maybe see like a trickle-down impact in their financial statements?
Yeah, so if one of the conditions that you met has now been removed, and so long as you meet the other remaining conditions, the accounting is basically going to be you no longer are going to have to separately measure that instrument, remeasure that instrument at fair value. So if previously if you had a liability classified warrant, for example, you had to mark that to market every reporting period. Same with a derivative, you have to mark that to market every reporting period. So you would essentially unwind any of that previous accounting through an adoption date kind of adjustment. So depending on whether you adjust as of the adoption date or back to the earliest period, just kind of thinking about the periods impacted. So unwind any of that previous accounting that was done. One thing you also probably need to think about is that the change in classification on any of those freestanding instruments or embedded features, so it's now going likely from a liability to equity, it could have an impact too on any previous discounts you may have recognized. So if you, for example, had an embedded feature in a debt instrument that you separated as a derivative, you likely allocated some proceeds to the derivative, and that created a discount on your debt. Well, if you're removing that derivative now because it meets a scope exception, you're going to have to remove that discount, and so you're likely going to also have interest expense that needs to be unwound. When you change interest expense, if you're a taxable entity, also you're likely to have some tax impacts there for some of your deferred tax balances. So also have to think about any tax impacts as well. So there are some things you kind of have to navigate through the transition adoption period, but once you kind of get past that hurdle, I think then the requisite accounting is much easier.
Okay, let's move into the third and final topic, earnings per share. What do our listeners need to know about earnings per share under this new ASU?
Yep, so one of the main impacts the standard had on EPS is that the treasury stock method can no longer be used to calculate diluted EPS for convertible instruments. The next is that when an instrument does have a cash settlement option at the issuer's option, the effect of the potential share settlement has to be included in the entity's diluted EPS calculation. Under current guidance, an entity is allowed to rebut this presumption if it has a policy and a history of cash settlement. Therefore, this amendment does affect both the basic and diluted EPS calculations for convertible instruments and freestanding instruments that could result in cash or share settlement.
Yeah, and one thing I'll caveat on the kind of the share settlement option is that that guidance does not apply to certain liability classified share payment awards. So just kind of keep that in mind as well if you have any of those. And then there wasn't one additional change to EPS, and it really relates to equity classified convertible preferred stock that has a down round feature. So previously that would have been captured by applying the BCF model, but now with that BCF model going away, any of those instruments that do have that down round feature are in the scope of that guidance would need to include that as well in their earnings per share calcs.
So I assume the FASB will clarify some things in the pre-existing guidance when they issue a new standard, but is there anything else we need to add on the EPS front?
Yep, so the first thing they clarified was that an average market price should be used to calculate diluted EPS, the diluted EPS denominator, in cases where the conversion rate or exercise price is variable. And then secondly, they clarified that an entity should use the weighted average share count from each quarter when calculating the year-to-date weighted average share count, except in cases where one of the quarters has a loss.
All right. I think that covers our 3 targets, and now we can transition into the effective dates and transition guidance. I know the ASU was originally issued back in 2020. Did we see many companies early adopt in 2021?
There were some companies that did, but it wasn't widely adopted. I think this was largely in part to many entities struggling with other complexities, so both operationally and from an accounting perspective due to the ongoing pandemic. I think some companies who hadn't looked at the transition guidance for this ASU were surprised that they couldn't subsequently adopt in a later quarter in 2021.
And when do private companies have to adopt by?
Yep, so the amendments are effective for private companies beginning fiscal year 2024. Early adoption is allowed, but similar to public companies, it would have to be adopted as of the beginning of their fiscal year.
All right. And can you briefly touch on the applicable adoption methods?
Yep. So the board decided to allow entities to either adopt using a modified retrospective method or a fully retrospective method. Under the modified retrospective method, entities will apply the new standard to financial instruments outstanding as of the beginning of the fiscal year of adoption. And then the cumulative effect adjustment at the adoption date will be recognized in opening retained earnings. If under this method, EPS amounts are not restated in prior periods presented. Opposite of that, so under the full retrospective method, entities apply the new standard impacts to financial instruments outstanding as of the beginning of the first comparative reporting period, presented in their financial statements. And then under this method, EPS for all periods presented is restated.
And does the FASB intend to look at any other additional topics within the debt and equity financing space? I think I heard there was a potential phase 2 ongoing. Adam, can you talk about what that might entail?
Yeah, so you'd be correct. There is actually a phase 2. It was actually originally contemplated in phase 1, but there was they weren't in agreement particularly on what all the changes would be related to what now is kind of going into phase 2. So to not hold up the release of phase 1 of the project, they decided to separate it and issue ASU 2020-06. But phase 2 is on the current technical agenda, and it is still also looking at kind of the own equity guidance, distinguishing liabilities from equity, and really focusing in on what's kind of known as the indexation guidance within 81540. And so there's really kind of 2 parts of that indexation guidance that you have to kind of walk through. So step 1 is evaluating contingent exercise provisions, and step 2 is evaluating settlement provisions. And certain nuances in there can cause you to fail indexation, and there's some, again, complexity, and that's the reason it's being looked at much more closely. That they're trying to figure out, is there a better path forward? So they had their most recent meeting on this back in February of this year, and kind of narrowed down the scope of what types of instruments would be this guidance apply to. And then they also kind of put out directives to the FASB staff to really start to develop some alternatives for the guidance. So that's kind of where it stands right now. Obviously, they'll do that, probably have some more board discussions back and forth, and eventually issue an exposure draft on that. That'll get reviewed for comments from the likes of preparers and accounting firms and et cetera. So we'll see where this kind of heads, but definitely keep an eye on it if it's this topic's of interest to you or it impacts you.
Awesome. I think that's a great place to stop our conversation for today. Sounds like a little bit of short-term pain for some long-term gain. We love lifting complexities. In ASC 2020-06, if you counted, let me know. Thank you guys for enlightening me and all of our listeners and keeping us up to date on the relevant accounting matters. And thank you for following along on another episode.